I just want to take an opportunity to ask one of the newbies in the room to take 30 seconds and share about her life story. Britt, you're on the spot.
Oh, wow.
Because you weren't here. You have 30 seconds to say who you are and what one word defines you.
Good morning, everyone. I'm Britt Anderson with Parkinson's Home Users. I guess the one word that would describe us would be serve.
There you go. Oh, of course, your dad put me up to that, so you.
Yeah, leave her alone.
Hey, Daddy!
There you go. Okay. Next up, we have Jeff Taylor from City National Bank. Jeff is like I'll just say the protector of the vault, if you will, with the bank. He does a lot of underwriting, and so you're going to get some really interesting insights on what the bank or your lender's perspective is today as it relates to when the next recession hits, because they're always looking that way. So I'd like to introduce Jeff Taylor.
Yeah, Josh. Right. So when Jeff asked me to speak, I knew that I'd be in an audience full of a lot of bright people, and kind of the first thing that came out is, what could I offer that's a little unique from maybe what the other speakers would offer. So, my goal today is to really kind of focus on a bank perspective. Whether you're dealing with banks now or you deal with banks in the future, at some point it's almost an inevitable part of running a business and should be applicable to pretty much everybody. Just a little background on me. Like you said, I'm currently I'm in a credit approval role. I manage underwriters. I do a little bit of underwriting, and I'm that pesky guy that asks those detailed questions about your business just to make sure we feel like your risk profile is appropriate, that a loan made is going to be a loan paid as agreed. And a lot of times there's a disconnect with why are these questions being asked? Why is this relevant? So I'm going to try and give a little bit more on that, but also in the context of recession planning itself. I've been in Central Florida for my entire career, about 15 years. About half of that has been with smaller community banks in the area, and about half has been with bigger banks. So I've seen both sides. I was at a bank, RBC Bank was later acquired by PNC Bank, but when the recession hit, that's where I was at, and there was a lot of overreaction on banks' parts. It got to the point where you couldn't get a loan unless you really didn't need it. They were giving loans to the super wealthy, the best businesses, and that was about it. It was a terrible recession, and it probably isn't going to be the expectation of future recessions. But if people who could get through that recession, you'd think could get through about anything. So maybe just quickly a show of hands so I can gauge my audience. How many people here were either business owners or senior management from 2008 to 2010? Okay. Anyone here lose a job in that time? How many people here had difficulty with banks in any part? Some more there. It's common, yeah. Bankers are kind of lumped with lawyers now, so I understand. So I kind of want to start with this slide, because I think to me, if I'm going to explain the fundamental disconnect I frequently see with a business owner and the mindset of a bank, it kind of lies in here. My experience with a typical business owner, especially a small business owner who's entrepreneurial, not afraid to take risks, is looking for opportunities, they're very much in the now and what they're going to be this year. And the bank mindset tends to look back at your past financial statements to say, hey, this is the demonstration over a multi-year period of what they're going to perform like. That's where they feel comfortable, is your past 3 years of financial statements. And it can be hard for an owner who knows they're killing it this year to potentially be declined because of past year performance. part of that, and I'll get into that a little more on the next slide, can be because of a financial statement quality. When you're looking at a year-end financial statement, whether it's a CPA audit prepared, reviewed statement, or tax returns, it's what the banks consider official. You have an outside firm saying these are accurate, or you're willing to put your name on those numbers going to the IRS, and it's tax fraud if they're not accurate. So, that's where banks feel comfortable, is looking at those official statements. And a year-to-date, a company-prepared statement, that feels a little to banks like stated income. They're easy to make up. There's no sure way to verify that they're accurate. So it's really important to have that mindset of being credit-worthy. They're really going to be looking at the year-end results as their primary focus. So going into the primary reasons, at least recently, that I'd say are happening, at least I'm experiencing, at my institution, City National Bank, and from 2017 to 2018, that can be one aspect. Maybe it's the statement quality. They may look good on the current statements, but really the year-end ones didn't look good. But a lot of it comes down to financial ratios. The primary ones that banks look at, I'd say, are debt service coverage is the most common. As the businesses get bigger, operating leverage ratios. And that's really just making sure both you have manageable debt as a whole that can be retired in a certain number of business cycles, but also that your cash in is greater than your cash out that's required to run your business.
Talk a little louder. The mic is just for the camera, so it's a little hard to hear you in the back of the room. It doesn't go to the room.
I apologize. Okay. And it's this, right?
Yeah, that's just for the camera, so the room doesn't, you just have to.
Okay. Oh, good to know.
Yeah.
Good to know.
Fake mic.
So yeah, financial ratios in general are very important to a bank, and it really comes down to the debt terms you have versus the cash flow of your business over the past year. Some other reasons for declines, compliance. BSA is a big emphasis in banking these days. Banks are going to Google search you. They're going to do background searches, and they're going to look for character blemishes. So, they're very picky on that. I saw a deal decline for a woman who had a bankruptcy 15 years ago. If a bank approver sees something that they feel feels like a character blemish, it can be that simple to turn down a loan. So it's a big thing to focus on. Your personal life can eventually impact the business for sure. And then just one other thing that came to mind is just not enough equity in a transaction. Typically, banks are going to require, depending on the collateral type that you're wanting to finance, a specific amount of cash equity that you've put into it, and sometimes you don't have that type of cash to meet the requirement at the time, and those are federally regulated. So you don't have, as a banker, you don't have the ability to go outside of some of these things. My particular bank, we get looked at by the OCC, the Office of the Comptroller, every year and a half, and they come in and they look at things according to the federal government standards, and if you're, not looking at it the same way, you get written up by them. So part of what's getting handed off to you guys as business owners and management is really coming down from, it's really a uniform way of looking at things that to some extent is outside a bank's control. So then this next topic, and I heard, I'll go through some of these in a little more detail, but some of these will kind of be a general theme from the conference today. Other people may be saying the same thing. For example, the fourth one on here was a diversity of sources, avoiding concentrations. It sounds like that's going to be covered fairly well, so I may glaze over that one a little more quickly. But starting with the first one, and these things are probably a little less common knowledge. Those reasons for decline. What will happen the next recession is those reasons will increase. A bank's, risk avoidance tolerance will heighten. So, there will be a lot more reasons why they turn down loans. So, and some of these things take, multiple years to really get ahead of. So the time is, I'd say is always now to start doing these type of things. As far as the first one, how many people here are familiar with financial covenants when getting a loan? Some banks do it, some don't. But basically what they will do is those ratios that I alluded to, they may have a debt service coverage covenant on your loan. So that if, they'll define it according to accounting rules in your loan agreement, and there's a minimum amount, and if you don't pass it, technically it's an event of default. And what happened in the last recession is anytime there was an event of default, banks would pounce on it. Made a lot of hasty decisions where if they'd worked with customers a little bit more patiently, it would have been better for everybody. But unfortunately, that didn't happen. And one of those things that can be an event of default is if there's financial covenants. So, if you were to come across one of these as you're establishing a loan, I think it's important to build in some flexibility into that. They'll set a specific amount, and you can talk through what your performance is today. And this is where really you have to know your business in general. Maybe you have that key client that could be lost. How much realistically things could get worse in a down year, and kind of build that into your covenant amount. And work with your banker to say, hey, let's get that bar a little higher. I want to be safe.
Is the financial covenant gross revenue, profitability, dollars I have in your bank?
It's typically debt service coverage, operating leverage. So debt service coverage is going to be EBITDA. Really your net income plus your non-cash expenses, and your interest gets added back. But then on the bottom half of that ratio is going to be your required principal and interest payments in a year. So they're going to get a debt schedule from you and say, you got to make this, and this loan payment, and this is your cash flow to support it. And theoretically, to be able to pay your bills, that ratio has to be over 1. A lot of banks set the benchmark at 1.1, so you kind of got about a 10% cushion there. But keeping that as low as possible, is helpful so that you don't run into a situation where it's a tight year. Maybe you do lose a little bit of cash, and all of a sudden you've defaulted on a loan. They can theoretically come and take the collateral and freeze your bank accounts. It can get very difficult very quickly. So that's just something to bear in mind. As far as the capital expenditure cycle, I think we all do, in our own individual lives, separate from business. Like, say a job's going well and we get a bonus, we get a surplus, we have a great project that goes through, we make some good money. We always have that option of maybe pay down credit card debt, do some repairs on the home, or go on a nice vacation. It really is the same thing in a business, just on a greater scale. I know the mindset of a lot of entrepreneurs is, don't be afraid to take risks, grow, and there's that fine balance of, where growth can be too aggressive. It strains cash, and then a recession hits, and you're not fully aware to absorb what changed. I'm not going to tell you, on every decision has to come down to you and your own risk tolerance. But what I can tell you is, from a bank perspective, those things are very, very relevant. If you're looking at someone with, fairly tight ratios, and they're going to double in size in the next 2 years, you're really going to want to get in the weeds and see, can they support their loan payments if everything doesn't go according to plan? That they're going to build into their projections some sensitivity there. What if a key customer were lost? Kind of down in the next one, what's kind of your break-even cash flow? And in that regard, one thing you can do to help your businesses is look for ways to lower the fixed costs and make more of it variable based. And I put in there just the slide, just the one example of subcontracting. You know, if you have any amount of seasonality to your business where your employment needs could go up and down, a nice way to you know, avoid staffing people that aren't needed for the slow times is be able to outsource some of that work with subcontracting firms in the busier times. And that way, you know, if a client's lost and revenues go down, your expenses, you know, they'll go down as well. They won't be tied to that. You won't have to make the tough decisions for layoffs and those type of things. So as far as the diversity of clients, you know, that was kind of already mentioned. I'd say a bar I'm typically looking at when I'm speaking with business owners is kind of that first bar is any customer over maybe 10% of revenues. We want to hear a little bit of background, you know, how long you've done business with that customer. Once you start hitting like 20%, 30%, we'll start looking at contractual terms, you know, really, you know, getting a little more detailed in that. And it's not just customers, it's suppliers. It's if you have one, you know, one new project that's very large, a type of, you know, the ways you generate revenue. Maybe you have multiple faucets. Maybe you have one or two that, you know, could be subject to a new entrant coming in and you know, doing that better, and you know that goes away overnight. So there's a lot of different angles that you can be concentrated. You know, key employees is really a concentration there, where it may be, you know, a talent pool. So, you know, that's just something. The more you diversify, the better you're going to be able to absorb unexpected things in general. And then the last one's kind of along the same lines. It's look for ways to build up your cash reserves. You know, businesses fail because of cash, and one of the biggest strains on cash is growth. So it's that right balance of, you know, when to grow. It could be, you know, you may see a good opportunity in a new market and say, hey, I can take that, or I could stabilize this product line better, pay down a little debt here. Again, it's not always a black and white answer, but I can tell you from a banker's perspective, it could make the difference of getting a loan now, and especially in a recession. So kind of just wanted to keep it high level for now, and then maybe just open it up to questions. And
I have a thought. Can you give an example the last year where the bank actually declined a company because of some of the weaknesses that you alluded to earlier? Can you give an example of something that was where you had an established company coming in and you had to say no?
Yeah. I mean, one thing I've definitely seen a lot of is a company that is going to be acquired, recently, you know, established a new business line where it's kind of, they've projected what they're going to do with that. And they have cost in it, maybe they have a loan associated with it, but you're really relying on, you know, it's a belief. You don't have that tangible result. So a lot of banks, you know, if you are growing, if you're establishing new debt, if your costs have gone up, you know, banks are going to want to see a multi-year period where, at least based on your financial statements, you could cover that if everything doesn't go according to plan. The examples I can think of are a lot of larger corporations. My role is more in corporate underwriting now, less on the small business side. So these are a lot of times leveraged buyouts where a private equity group comes in, levers them up, and puts it on the business to repay a lot of debt, and all of a sudden their leverage ratios don't look good. You could look back and they could be a very big, successful company for many years, but once you create that element of unknown, where it's kind of like your guess is as good as mine, what they do under, it's once you get that element of unknown, a lot of times will pass. And banking's very competitive right now. Everybody's looking for reasons to make loans right now. So if if my institution passes on a deal, almost for sure likely someone else will do it. But what'll happen in a recession, and what I experienced is, everybody starts shutting down. And people who kind of have any amount of vulnerability that need it the most are the ones who suffer in a recession.
What has your bank's experience been with approaching ESOPs and getting leveraged loans for an ESOP acquisition?
As far as ESOPs, you like the employees to have this feel like that, they're part of the company, that as the company succeeds, so do they, an ownership interest in it. We do non-recourse financing for larger institutions. So, if I were looking at an ESOP, if it were a company with $25 million in revenue and up, and I wouldn't have personal guarantees, it could be a plus. If it's a very small business with limited guarantees, you really want to find the material, a key owner, the most material operators, and have them personally guarantee the loan as well. And you could have an ESOP where they do that. So it's not something as much as it can be good or bad, but in general, having employees vested in the business and wanting it to succeed is a plus. As far as banks, a lot of times it comes down to their credit policy, and there's usually specific thresholds in which they'll require, guarantees or not.
You referenced Google searches when they're evaluating and actually going in,
Yeah.
and I think you made a note about personal character and so forth.
Yeah.
It's a serious question, but are they actually looking, going to social media, going that deep and looking into people's?
They can. Yeah. I mean, I'm not. When I'm doing a search, it's funny. There's you can put specific language. Our bank has like a copy paste language where it's and fraud and crime and this, and then there's about 20 different terms. And if you put it with the right parentheses and this with a name, it'll search for all those specifically tied to that one person. So it comes back with random news articles, blogs, lots of things, and it's up to us to kind of filter it. We're not going to take hearsay and decline a loan because that a larger company that is going to obviously have disputes that are subjective, that's different. But if you come across something where it seems material, I mean that it's almost a surefire way to turn it on. It comes down to if that Facebook stuff is going to come up in a search or not. I haven't seen a lot of Facebook results, though, to be honest.
I just had a question because I know how you think. Not a lot of people raise their hand when you ask about financial covenants, and I think this is relevant for people that have maybe loans from multiple people. Can you talk a little bit about cross default, because I think that's something that's important for people to understand.
Yeah. So in your loan documents, what a bank will do is put a threshold that if you default with one lender, you actually default with them. And a lot of people, it's fine print. People don't always read this, but say you make a $200,000 loan with Bank A and an $800,000 loan with Bank B. And in Bank B's wording, they've got some cross default language in there. If they find out you've defaulted on that small loan, they can put you in default on the loan with their institution. So it's important to know that having multiple banks as a source is a good thing, that diversification aspect. But the ability to totally separate yourself from that can come down to what's actually in the fine print.
Great question, and one other one that I think is relevant for it. Talk a little bit about what our default rate is, and then how good our financial status is, and why it's good to think, obviously, like we think.
Yeah. So our default rate, it's funny, we have so few defaults right now. It's going back to the recession, you saw a lot more. I mean, I think we've had two or three of 200 customers established it in our particular division have defaults, and part of that's attributable to a good economy. Part of it's as a result of the last recession, banks kind of beefed up their analytical approach. There's a while where they're probably over the top. It's kind of come back down. It might be in a good midpoint right now. So part of that is it's on the underwriters and, your credit personnel to ask the right questions and get behind trends and the detail. And that's fairly typical in banks, but I mean, it all can change.
Why would a bank want auto default language? I can't imagine that it's good for the bank to default a loan.
Yeah. And I haven't been in a workout situation, and I see the same thing. I mean, realistically, it doesn't change a lot. In my opinion, it doesn't change a ton. But what happens is when there's default language, all of a sudden you control the situation. Banks like to get ahead of things, so they'll really put in the documents what they believe are the kind of leading indicators of going out of business. Our legal team can take certain action if you're in default, but they can't take if you're not. Being able to get to your collateral, leverage a situation can be better in advance than when everything hit the fan. So it's really just designed to kind of be in control earlier rather than later. That's probably the best explanation I can give for why you'll have too much event of default language.
Just to give you a warning about myself, I don't have a filter. The underwriter guys, to me, and everybody here's dealt with the banks, you're like the guys that are behind the black veil,
Right.
And my fault with banks and my whole career has been that the underwriters are the guys that never come talk to the owners and stuff at all. I mean, they never have a conversation with them at all, and it's like y'all are just looking at the paperwork and there's blinders to everything else. I've shied away from big banks. You can ask him, I went to a small bank and there's 6 guys sit at a table and you're sitting across from them and they say yay or nay, and that's how it works.
Yeah.
And it's a lot better way to do business. And now I'm in a position to where I've outgrown my bank. My business, because, like they tell us, we shouldn't have 20% of our customers, any customer more than 10 or 20% of our business. And I'm at that point with my bank that I want to grow faster than they are growing. So I'm going to have to go back to the dreaded big bank. And matter of fact, they're underwriting today as we speak, and it's something that just rubs me just bad.
I understand.
I can't stand it.
I can tell you for Sean, he knows because he's a sales guy in my institution. Every customer of his that brings in a loan, I ask the underwriter to have a conversation with, the owner or the CFO and have a back and forth, not make a decision where, there's a story behind the numbers. And you'll get a lot of variance from bank to bank about how much they'll actually get in and try and understand it or make these assembly line type decisions. And my opinion is to compete as a bank, you're much better off getting to understand the whys behind the numbers, not just make decisions on the numbers. But
yeah, but it's funny you made the comment earlier, they'll bend over backwards to give more money to people that don't need it, you know what I mean? And I left the bank particularly that treated me bad back when I was, when things were bad and things were good, and they're calling up, hey, Don Wilson, lend you money. I said,
right.
Not no more.
Yeah. And it changes in a recession.
And they hate that, because now they want our business, but they weren't there when I needed the help,
Yeah.
American Express was.
Yeah. Last question, see if you had one.
2005, mortgage-backed securities.
Yeah.
Fast forward, student loan debt.
Right.
Can you comment on that?
Well, the rates are a lot higher.
Is that something that's trigger, or what can you?
Well, I'd say from my perspective, all I see with student loans is, an annual payment that you're going to have to cover, and you're never going to be able to get out of it. I know the rates have gone up a lot higher. I remember paying mine off at like a 1% interest rate, and I have friends now paying 6%. So huge difference. That's something that they'll consider it in your personal requirements. There's a couple angles bank look at your cash flow, and small businesses, besides the business's cash flow, they call it a global cash flow, and they really combine the personal income and debt of the owner along with the business, because as a business owner you can kind of move money to and from. You really kind of blend, and so then your student loan is no different than
The
a
question
business
was
loan.
more directed toward, more of a step back. Is this a potential recession trigger? Or, do you see a vulnerability like the mortgage-backed securities, out-leverage us and cause the housing crisis? I'm asking you to
Yeah,
crystal
no,
ball for us.
I don't presume enough to know about macroeconomics to really answer that. I mean, I would say in general, people straight out of college need help, not higher rates. So it's not, I don't view it as, I think it's worse as far as stimulating the economy. Like people straight out of college need the lower rates and help to get on their feet, and then they'll pay it back better later on. It's kind of like in a default situation, working with the customer, maybe, easing the payments is better for your long-term return as a bank than immediately using the hammer. But that's, from a total macroeconomic perspective, I wouldn't be able to really tell you.
Jeff, I just want to make one follow-up comment on the conversation you had on choosing your bank, because I think this is a very pertinent, and you probably have a little more value on it, but choosing your bank is obviously important with how that relationship is, as we discussed here a little bit ago. But I think there's two questions you got to ask yourself in selecting a bank. Is that bank going to be there tomorrow? And there's two sides to that, right? Is it a small community bank that's primed for sale because times are great today, and then you're not going to be with that bank? And then are you, and loosely defined, a small player with a very large bank, and when times change tomorrow the other way, that bank's pulling out of you, right? So it's very important not only in your relationship, but is your bank the right fit? And that's a deep question to ask. But both of those events at the low end and the high end are occurring and are going to occur. So just something to keep you thinking about as you are making banking relationships.
That's a very intriguing point, because back in 09, 10, where you had everything, that's exactly what happened.
Absolutely.
You were absolutely correct. When you're thinking about your growth strategy and succession strategy, if the bank is primed to be a takeover target, and there's going to be a whole nother set of criteria that the big mama or big papa bank is going to impose, which could cause your particular company and your particular industry to be, let's just say, allocated out of the portfolio. So it's really important. Good stuff. Thank you.